Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Tellurian stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Tellurian's focus is on the upstream part of the oil and production process. It delivers natural gas to customers all around the world. They are developing a portfolio of natural gas production, LNG marketing, and infrastructure assets that include an LNG terminal facility. That facility is called the Driftwood Terminal. There's also the Driftwood Pipeline connected to the Driftwood Terminal. The company is headquartered in Houston, Texas, and was founded in 2016. The ticker trades of the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 800 million market cap. They're trading at 142 a share, and they have 563 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they're still not at a break even yet. They're losing cash flow each year. And it's getting worse. It was negative 400 million in 2022. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, and that grew more than 1,000% from 30 million to 392 million. That's the one bright spot. Their revenue growth is phenomenal. This is the company's income statement from their 10K. This shows us 2020, 2021, and 2022. Of the $392 million of revenue, natural gas sales was $271 million. Natural gas is a fossil fuel source. The largest component is methane. We use natural gas every day to heat our homes, electricity to run our cars. It's also used in many of the products we purchase. When you hear the term conventional natural gas, that's found between layers of rock. Unconventional natural gas is found in tiny spaces within shale, sandstone, and other types of sedimentary rock. Associated natural gas is found in crude oil deposits. You could find natural gas on land, offshore, and even beneath the ocean floor. And if you ever heard the term coal bed methane, that's natural gas found in coal deposits. If you do identify natural gas at a location and deduce it's profitable to extract it, then usually you start by drilling a well. And technology for well drilling has gotten advanced, so you can do it vertically or horizontally. There's also something called hydraulic fracturing and fracking. This is when you force water at a high pressure down a well. It breaks up the rock, and then it allows the natural gas to flow up to the wells to the surface, so it's easier to pull. And once you get the natural gas to the top of the well, it's put into gathering pipelines and sent to processing plants. About 30% of their revenue comes from LNG sales, 121 million. LNG stands for liquefied natural gas. It is natural gas converted to liquid form, because sometimes you have to transport gas from one country to another, or sometimes within a country but there's no pipeline available, so you have to move it by truck. It's really hard to move natural gas by truck. They cool it down to negative 260 degrees Fahrenheit, which makes it 600 times smaller, so you could fit a lot on a truck. The last I looked, the two largest exporters of LNG are Australia and Qatar. I'm missing the R here. US is pretty close, so they should be number one in a few years. And the country with the biggest demand for LNG is China. Below revenue are their expenses. Their LNG expenses are 132 million, which are more than their sales, so that's not good. They're losing money. Same thing in 2021. They were losing money on LNG sales, but they were break even. Their revenue and expenses for LNG were identical. Operating expenses of 38 million. There's a lot of expenses to develop the locations at 69 million. Developing means erecting wells and building out their infrastructure. Depreciation of 44 million. They have lots of fixed assets they need to depreciate each year. General and administrative of 126 million. That includes payroll. In 2020, that impairment of 81 million. This is when they decreased the value of an asset on their balance sheet and passed through the loss onto their income statement. So maybe the value of the terminal decreased, so they had to lower it on the balance sheet. So total expenses are 410 million. Last year was 184 million. In 2020 it was higher at 200 million, mainly from that impairment. So they had a loss from operations of 18 million. It is better than prior years, but they're generating lots of revenue and still running at a loss, which is not a good sign. Interest expense of 14 million, higher than 2021, but a lot lower than 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Like the gain or loss on the sale of an asset might be in here. So they have a loss before taxes, so they don't pay any income taxes. A $50 million loss in 2022, which is half of 2021. 2021 was half of 2020. So a 9-cent loss per share. It's better than 2021 of a 28-cent loss. They are diluting their investors. They almost exactly doubled the shares outstanding from 267 million to 526 million. This is the asset section of the balance sheet, 12/31/21 and 22. Current assets are assets that can be converted into cash within 12 months, and it starts with the most liquid, which is cash, 474 million. Last year was 300 million. Accounts receivables, what others owe them, 77 million. Last year was 9 million. Then you have prepaid expenses of 23 million, up from 13 million. Of the 23 million, 2.2 million are prepaid expenses. This is when a company makes an advance payment for a product or service they haven't received yet, so it's carried on the balance sheet as an asset. $170,000 of deposits, 9.4 million are restricted cash. Restricted cash is cash that's set aside for a specific purpose, like for example, to purchase a piece of machinery. They do lots of hedging against the commodity prices, that was 10.5 million, and 1.2 million of other. Let's look at their non-current assets. These are assets that would take longer than a year to convert into cash. 800 million of PP&E, last year was 150 million. Here's a breakdown of their upstream assets. Proved properties, 413 million. Wells in progress, 56 million. And they have to depreciate those assets each year. They depreciated them 92 million, so the book value, the carrying value is 376 million, up from 65 million. Then there's assets in the Driftwood project, 52 million of land, 292 million of terminal construction, and 56 million of finance leased assets. 400 million of Driftwood assets, up from 83 million. Then there's other fixed assets, leasehold improvements, 13 million. That's when you improve a property, like add another floor, or in their case, maybe add a well, and 1.8 million of depreciation, so the carrying value of other is 11 million. Last year they had 110 million of deferred engineering costs. Deferred engineering costs are long-term prepaid expenses. Remember, prepaid expenses is when a company makes an advance payment for a product or service they haven't used yet. So they're making advance payments to the engineers where they haven't used the asset yet. I'll give you an example of a prepaid expense. Say you buy a piece of land, and then you have to pay a contractor $120,000 to build a house on that land. So every month you give your contractor $10,000, so you make an advance payment for a product you haven't received yet. You will not have access to the house until 12 months, but you're still incurring these expenses every single month. So you carry that on your balance sheet, $10,000, and you keep adding $10,000 each month. And then once 12 months is complete, you remove it from your balance sheet, $120,000, and you put it onto your income statement as an expense. Then there's 63 million of other. Here's a breakdown of the 63 million, 300,000 of land, 900,000 of permitting costs, 13 million of right of use assets, operating leases. So these are assets another company owns, but this company is leasing those assets. So it's carried on the balance sheet as an asset and a liability. The leases are the liability portion. We'll see a similar amount on the liability section later. 25 million restricted cash. They invested in other companies, 6 million. They issued a note to somebody, 6.6 million. That means somebody owes them 6.6 million. If it was notes payable, that means they would owe somebody that amount. 9.1 million of pipeline materials and 2 million of other. So their total assets are 1.4 billion. Last year was 620 million. So their liabilities plus their equity will equal 1.4 billion. These are the liabilities on their balance sheet. They have 5 million of accounts payable. This is how much money they owe other businesses for product or services they purchased. There's accrued and other liabilities, $129 million. And accrued liability is when a company has incurred an expense it has not paid yet. $72 million of Upstream accrued liabilities. We all have accrued liabilities in our life. Our electric bill is an accrued liability. We're accruing that debt throughout the month, and based on how much electricity we use, we're going to have to pay that bill. Payroll is a common type of accrued liability because everybody's working, but they don't get paid until the end of the week or after 2 weeks. So you as a company are incurring that debt each day, but you don't have to pay it for another 2 weeks. They have $730,000 of accrued taxes. They have $4.4 million in debt on the Driftwood project, $2.9 million in lease liabilities. Remember we talked about this earlier on the asset section. They're accruing interest of $5.8 million and $6 million of other. They have $163 million of short-term borrowings. This is debt they owe within 12 months. And long-term borrowings is $380 million. This is debt due beyond 12 months. Here's the $163 million of short-term debt. Senior secured convertible notes, current. That means they're due within 12 months. And then you have senior secured notes, non-current, $327 million. And there's notes due in 2028. So when you add up the $327 million and $55 million, this is the $382 million they owe in non-current liabilities. This $54 million is senior notes due in 2028, but this is December 2021. So they're just showing you what it looked like last year. They had $54 million in debt. Now they have $382 million. You see $54 million in 2021, $382 million in 2022. All this information is in the 10K in case you wanted to look at it. They owe $50 million on long-term finance liabilities and $24 million of other non-current liabilities. So what they owe as of 12/31/2022 is $450 million. Last year it was $114 million. This is their equity section on their balance sheet. Equity equals assets minus liabilities. They did issue some preferred stock, but most of their funding is from common stock. They raised $1.6 billion from additional paid-in capital. Most of that is from common stock. An accumulated deficit, that's a sum of all their prior net incomes. So their total losses is $980 million. So they have $672 million of stockholders' equity. If you want to understand these numbers a little deeper, you can look at the report, Statement of Changes in Shareholders' Equity. I'll show you that right now. This is the Statement of Changes in Shareholders' Equity. This is probably the fourth most common financial statement. Balance sheet and income statement are 1 and 2, then statement of cash flows is 3, and then this. So preferred stock is up here. They don't really break that down. The beginning balance for common stock is $4.8 million. This was the balance as of 12/31/2021. In 2022, they issued $680,000 of common stock. Last year, $1.4 million, and before that, $800,000. So the common stock ending balance is $5.5 million. Additional paid-in capital beginning balance is $1.3 billion. They raised $300 million from issuing common stock. The number we looked at just before was the par value of the common stock. That's not how much money they raised. Usually each share of common stock has a par value associated with it, like a penny or a tenth of a penny. That's just a way to keep track of the number of shares in the market. This is how much money they raised. Last year they raised $400 million. In 2020 they raised $100 million. Then you have stock-based compensation for your employees, $3.6 million. Last year, $7.9 million. Before that, $8.6 million. Additional paid-in capital at the end of 2022 was $1.6 billion. Accumulated deficit went from negative $930 million. They had a loss of $50 million in 2022. So at the end of 2022, it was negative $980 million. Let's look into the statement of cash flows. That's broken out into 3 sections: operating, investing, and financing. First is the operating section, which is the most common. The way you calculate operating cash flow, you start with your net loss. That was $50 million. Then we have to add back the non-cash items on the income statement. Depreciation is a non-cash expense, so we add it back, $44 million. Stock-based compensation is another big thing you add back, $3.6 million. They pass through a $9 million gain on the income statement, so we have to minus that out. That's a non-cash item. Then you have changes in working capital. When a company uses debt, uses accounts payable, that increases cash flow. When a company decreases their accounts receivables, meaning they received payment for services in the past, that's an inflow of cash. In 2022, they had a $16 million outflow in cash for changes in working capital. So maybe they paid back some of the accounts payable. But you could look on the 10K if you want a breakdown of this number. Maybe I'll do that in the next video I do. So even though they reported a $50 million loss, they actually lost $22 million of cash flow. And remember they posted that big loss in 2020 of $210 million? Well, we have to add back that impairment, that $81 million impairment. So their cash outflow was only $70 million, even though they reported a big loss. This is the investing and financing section of the statement of cash flows. The top part of the investing section is acquisition and development of natural gas properties. That was $344 million in 2022, up a lot from 2021. The Driftwood project, they spent $176 million of cash, $24 million of land. They have $6 million investments in unconsolidated entities. This means they own less than 50% of another company, so it's not consolidated into their financials. If they own more than 50% of another company, it would be consolidated into their financials. They had a cash outflow of $6.6 million in a notes receivable, and a $9 million cash outflow on capitalized internal software. So in their investing section, they had a cash outflow of $565 million. Last year was only $58 million. But it looks like it's a good use of cash. They're growing their business. Hopefully this leads to greater free cash flow in the future. In their financing section, they had a cash inflow of $300 million from common stock issuances. We saw this number on the statement of changes in shareholders' equity report. And there's expenses associated with this stock issuances. You have to pay an investment banker to help you with these common stock issuances. Those expenses were over $9 million. They took on $500 million of debt. And there's expenses and costs associated with taking on debt of $11 million. So they had a cash inflow of $800 million in their financing section. So it looks like they're using a lot of debt and equity to finance their growth. Let's look at the capital structure. $700 million of equity, $600 million of debt. They're 53% equity, 47% debt. And they could pay off a lot of the debt with the cash on their balance sheet if they wanted to. If they did use all the cash on their balance sheet to pay down some of their debt, they would only have $124 million of debt left over. They have a really high WACC according to Finbox. I used the middle one of 16%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $700 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $688 million. We divide that by 563 million shares, and we get a calculated stock price of $1.22. They're trading at $1.42, so they're trading at a 16% premium. It's a sell according to the model. Two analysts project their 2025 revenue to be $358 million. The projection for 2024 is $391 million. For 2023, it's $358 million. I continued this trend into 2026, and I got $325 million. That's how I got their future revenue estimates. The average company in their industry converts 29% of their revenue into free cash flow, so I multiplied their future revenue estimates by 29%. That's how I got their future free cash flows. I did a video on this company in September 2021 when they were trading at $3, and my valuation was $1.87, which is pretty close to where they're trading at. And you should read some of the comments in that video. People are like, "You're such an idiot, you don't know what you're talking about." Because when you buy the stock, you only want to think of the positives, and if somebody says anything negative, remotely negative, you get very defensive. I'm sure they would still just say now, "I got lucky, I'm still an idiot, the company's going to be worth a lot." It may be worth a lot in the future, but I'm just going on the numbers out there. 4 analysts priced this stock, and the average price target is $2.45. The low is $1.30, the high is $5. Another 7 analysts priced this stock, and the average price target is $4. This is where the stock has been trading the last 5 years. So it was over $10 a few years back, and then it got real low. I think it fell below $1. In the first quarter of 2022, it got back up to about $6, but then it dropped a ton after that. It's been really struggling, the stock. Look how big that red bar is. That's why there's a big decline. When there's a red bar, that means the sell orders are higher than the buy orders, and the price goes down. When the red bar is really high, that means there's a lot more sell orders than buy orders. Same thing if there's a green line, there's a lot more buy orders than sell orders, and the stock price goes up. They have a really high beta, 2.3, so the stock is really volatile. It moves more than 2 times the market. It's down 75% in the past 52 weeks, while the S&P is down 7%. The 52-week low is $1, the high is $6.40. and the stock is trading below its 50-day and 200-day moving average. This is still a pretty popular stock. About 13 million shares are traded each day. Of the 564 million shares outstanding, 530 million are on float, 42% are held by institutions, and it has a pretty high short percentage. Over 17% of the shares are shorted. The CEO's salary is $725,000, and their total compensation package is $8.4 million. So at least somebody's making money through this company. It's certainly not the investors. In the past 12 months, there's been only insider selling, no buying, and it's all by the founder, Sharice Suki. He's selling most of his shares. 52% of the company is held by the general public, 42% by institutions, 6% by insiders, and 0.009% by private companies. Their employee count is up and down. They're currently at 171 workers. The biggest shareholder is State Street at 8%, Vanguard at 7%, BlackRock at 6%. The co-founder Martin Houston 3%, then Geo, D.E. Shore, Electron Capital Partners, First Trust, Paulson & Co., and Millennium Management. The best way to look at ratios to compare them to companies in the same industry. There are 81 companies in the same industry as Tellurian. And if Tellurian has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They rank 50th in market cap of the 81 companies. ConocoPhillips is number 1. Their ratios are decent. They don't generate much revenue, but they're growing a ton. Their 5-year annual revenue growth rate is above 100%. I cap it at 100%, so it doesn't skew the average too much. Let's look at some of the slides from their most recent presentation. The world needs natural gas. Demand is supposed to rise 50% in the next 25 years. LNG demand has grown 7% annually over the last 5 years. And this company will be the first integrated global gas pure play in the US. Driftwood Phase 1 is well underway, with Bechtel having commenced construction in April 2022. And they're working on the next phase of Bechtel this year. Last year in 2022, they cleared all Phase 1 critical areas. They have gas production in Haynesville. This is a pipeline and LNG terminal that's in southwest Louisiana. All critical permits are secured for the Driftwood LNG terminal and pipeline. And as you know, their concentration is in Louisiana with the Driftwood terminal, which borders Texas. Houston is right here. This slide shows their growth in upstream production. They have 28,000 net acres. They have lots of potential because there's undeveloped acreage in the Bacia reserves. They have over 400 undeveloped wells, and 100% of their platform is gas. In the third quarter, they had 125 million cubic feet per day. That's up to 225 million. Their net acres grew from 22,000 to 28,000. Revenue went from 81 to 103 million, and adjusted EBITDA from 70 to 80 million. That's quarter over quarter, comparing third quarter of 2022 to fourth quarter of 2022. Here's an overview of their Driftwood LNG construction in progress. Bechtel commenced construction in April 2022. They completed all of critical Phase 1 owners' projects. That includes pipeline relocation, highway and road widening, and they exercise options on the remaining terminal land leases. In June of last year, they awarded Baker Hughes a contract for electric drive zero-emission pipeline compressors. And they're planning lots of additional site work throughout this year. This slide talks about the Henry Hub pipeline. The Henry Hub is located in Louisiana. This serves as the official delivery location for futures contracts on the New York Mercantile Exchange, the NYMEX. And this hub is owned by Sabine Pipeline. By 2030, the U.S. share of liquefied natural gas supply is expected to grow to 25%. Right now, it's around 20%. This slide conveys LNG's demand is supposed to exceed supply. There's expected to be 260 million tons per annum of new LNG demand by 2035. And supply is only 79 million. So that means 178 million shortage. So that's where this company comes in to take some of that market. How much does a USGC LNG terminal cost? USGC is US Gulf Coast. Construction is $900 per ton. Owner cost is $200 and financing is $200. So $1,300 per ton. So it's definitely not cheap, but it could lead to lots of growth in the future. The Driftwood LNG Phase 1, 2 plants, 11 million tons per annum. The LNG terminal development costs are $9 billion. Owner cost is $1.7 billion. Pipeline is $900 million. Financing is $2 billion, so total development cost is $13.6 billion. But that's a lot of capacity, 11 million tons per annum. Driftwood is really accessible, so it's ideal for exports. It has access to pipeline infrastructure, access to power and water, support from the local community. It could be a big risk if people are against the project, trying to pick it and get you out of there. It's a really big site, over 1,200 acres. It's fully permitted. EPC contract has been signed. EPC stands for engineering, procurement, and construction. And 30% of the engineering is complete. Tellurian's management team has 80 years of combined LNG development experience. Sharif Suki, who is a really big name in this industry, is the co-founder of this company. He founded Cheniere Energy in 1996, and he was chairman and CEO until 2015. Martin Houston is vice chairman, co-founder of this company, 32 years of experience at BG Group. The president and CEO, Octavia Simoes, he has 20 years of experience at Sempra. This chart shows that supply fails to keep pace with demand. And this is by year from 2011 to 2030. And there's expected to be a shortage by 2030. The average price on the bottom here, that's the Japan-Korea marker. Look how low it was in 2020 when oil prices crashed, $4.38. It was pretty low in 2016. 2022, wow, $34. That's why lots of oil companies were making money hand over fist. The price of oil went up so much. But it's come back down a lot in 2023 to 19. But if there is a shortage at one point, prices will skyrocket. So to summarize, I have them trading at a 16% premium. Upstream companies are the riskiest companies to invest in oil and production process. Midstream is a lot safer. That's why midstream stocks pay nice dividends, because of the safety. It's unlikely you're going to double, triple, or 10x your money with a midstream stock. With an upstream stock, you can. Of course, there's a greater chance of losing all your money with an upstream stock as well. But this company has great management, and if they can continue developing and growing, then they're going to be really successful. I rank their free cash flow as 1 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.